Beata Javorcik, who is the chief economist at the EBRD, joining me from Zurich. You were listening there to what Anna, and you've heard obviously the OECD's stuff. But now the EBRD, the European Bank for Reconstruction and Development, you've also been lowering the growth forecast. You're projecting 3.1% in your regions this year, down 0.5% from February. And you say the wedge between gas prices in Europe and those in the US widened, exceeding a factor of 5, and weighed on European competitiveness. Now, the issue becomes, Beata, what to do about it. And I mean, obviously, yes, peace in our time and a ceasefire is what you want. But in the absence of that, what do you do?
Well, Richard, you are absolutely right that we cannot influence what's happening in the world, but we can focus on what we can do ourselves. Now, the problem with the energy shock that Europe is going through is that it cannot be fixed very fast, but we can embark on the path to alleviate its implications. So, for instance, we can continue our investments in renewable energy. And actually, now prices of electricity in Europe are lower than they were in 2022 when the war in Ukraine started, because now we have a higher share of renewables in the mix, and that has made us more resilient.
Do you see possibilities of outright recession? I know the numbers don't suggest it at the moment, but if this continues, where de facto in parts of Europe you've got stagflation, then surely recession, or even technical recession, can't be far behind.
Well, I can see this possibility in Western Europe should the conflict last for a very long time. Things have not been rosy in Europe for a while. This is our second energy shock after the 2022, when the war in Ukraine meant that Europe started relying on imports of natural gas through LNG rather than gas piped from Russia. And that already raised the ratio of prices in Europe to those in the US, making Europe less competitive. Also, Europe has been hit by the wave of US tariffs, and that's an important market for European countries, particularly for Germany. So the situation has not been rosy. The momentum in manufacturing was weak when the conflict in the Middle East started.
On that tariff point, we know there's another 12.5% coming Europe's ways as a result of President Trump's 301, which we'll talk about. We'll talk about the political side of that after the next break. But on the economic side, I suppose one of the achievements is the way in which the EU and the European economy has weathered the storm, but will find it more difficult with these extra tariffs.
Well, weathering the storm has been relative, right? So as we show in the report, in Europe, we have seen a big decline in output of energy-intensive industries. And that's the result of high prices of natural gas and electricity we have in Europe relative to those prices in the US. Europe is also facing increasing competition from China. Exports of China are becoming more and more similar to what Europe is exporting. And at the same time, China is importing less of what we are producing here. So pressure points come from multiple sides.
When it gets as complicated as this, and I think you'd agree that the scenario is pretty complex at the moment, I often find it's best to go back to the gut feeling, because you can always find a number to bolster one thought or the other. So, your gut feeling, is Europe's economy in trouble?
Well, the situation is not rosy. Things could be better. But in many ways, we have been resilient, particularly when you look at emerging Europe.